I think 2021 is going to be a very volatile year in the stock market. Not only do we have a ton of stocks trading near record highs, but the economy is in horrible shape, and we have a lot of political and civil unrest just to make things even worse. But during times of volatility, reliable dividend stocks can be some of the best to own. Regardless of what the market is doing, you get to collect consistent dividend payments from them, and even when the stock prices go down, those are great buying opportunities because the dividend yields actually go up. So in today's video, I'm going to list off for you guys my top 10 absolute favorite dividend stocks, 10 of them. So we've got a lot to go through. These are my absolute favorite dividend stocks as of right now. Many of them I already own, some of them I do not, but I will probably be buying every single one of them at some point throughout this year, and they may make great additions to your watch list as well. So I hope you guys enjoy the video. It's going to be a lot of fun. I'll give you guys a quick little description of the company, talk about the dividend, share some of my quick thoughts, and we'll just run through the list. Hit the like button if you do enjoy the video, subscribe if you haven't already. 2021, it's gonna be a really big year for the channel. Got a lot of new ideas. We're gonna be doing a lot more frequent uploads, so make sure you don't miss any of that new content. Make sure you subscribe. But thank you guys for watching the video. Let's jump straight into this list. Okay, so in no particular order, we'll just count down from number 10 to keep it simple. And what better way to start than with a dividend king that I personally just started buying for the first time ever in 2020, and that's going to be 3M, ticker symbol MMM. This is a very large company that sells very popular brands like Post-it notes, Scotch tape, and many other household brands, different auto care and industrial products, and even health and safety products, including, of course, face masks that have become all the rage during the global health crisis. Financially, though, 3M's products are heavily exposed to the macroeconomy, and even though face mask sales have gone through the roof, it's not enough to keep their sales from dipping about 1% this past year before returning to growth in 2021. The recovery is dependent, though, on an improving economy, so 3M tends to be riskier than most, and it can be a pretty volatile stock, as you can see on this 5-year chart right here. But thanks to their massive size and decent profitability, they've achieved dividend king status after having raised their dividends for a massive 62 years in a row, despite already carrying a very large growth rate of almost 11%. Add it all up, and 3M is a core dividend stock worth keeping a very close eye on, and I enjoy owning it myself. Okay, now moving on to stock number 9, we have what is not only one of my favorite dividend stocks out there, but also probably my favorite renewable energy stock as well, and that is NextEra Energy, ticker symbol NEE. I personally do not own this one yet, as the stock has always felt just a bit too high for me to purchase, since I am someone that likes to do the majority of my buying when stocks are going down, and unfortunately NextEra is such a good company that the stock rarely ever dips, as so many investors just really want to own it, so the demand is always, pretty high. But I definitely think that I'll be buying this stock at some point in 2021, especially on their next dip. That's because NextEra has a solid business. They're actually the world's largest generator of renewable energy from wind and solar, and they're even a world leader in battery storage as well, all of which are huge markets that I only expect to grow much larger over time, given all the attention that renewable energy and climate change continues to get from the media and from so many politicians. As a result, Allied Market Research is estimating that the global renewable energy market will surpass $1.5 trillion by 2025. For context, NextEra is still expected to do less than $20 billion in sales this year, given the weak economy, so plenty of room for growth there. As far as the dividend goes, it's admittedly small at just about 1.8%, but if the stock dips a little to where that dividend gets like above 2%, I'll probably start buying the stock at that point myself, considering the double-digit growth rate alongside 25 years of consecutive growth on that dividend. Plus, I wouldn't just be buying this one for the dividend. I think as a company, NextEra will be much larger in the future, and that success should get reflected in the stock price as well. Okay, now I know these haven't been very high yields so far, but for stock number 8, we're gonna go with my personal favorite, very high yielding dividend stock, and one that I've been purchasing a lot of in recent years, and that is AT&T, ticker symbol T. The stock has been a very poor performer in recent years given the struggling legacy parts of their business like cable TV and landline telephone, but investments in 5G, fiber internet, and HBO Max streaming should help offset many of those losses, and at the time of this recording, AT&T remains a cash-generating machine with almost $30 billion of free cash flow over just the past year alone. That is very high. This allows them to pay a huge dividend that, thanks to the declining stock price, currently yields over 7%, and that's even with over 36 years of consecutive growth. That's very hard to beat by other companies in the market. We'll see how AT&T does over the long term, but at the moment, I'm really enjoying my huge quarterly dividends from this one. Moving on though to stock number 7, we've got another dividend king in a pharmaceutical, healthcare, and consumer staple giant, and that is of course Johnson & Johnson. With various popular products across various sectors, not to mention a V-shot for the pepperoni that they're investing heavily in to make sure it's one of the safest and perhaps most widely available options over the long term, which could kind of give them an upper hand over some of their competitors. J&J has been able to maintain solid financials over the years and will likely continue to do so for decades to come. In recent years, free cash flow has nearly reached $20 billion a year, which is huge profitability. And that's allowed them to not only pay a dividend for decades, but they've actually grown that dividend every single year for the past almost 60 years in a row. That's pretty crazy. That's getting up there to like 3M status. The yield isn't very high at less than 3%, but in my opinion, the stock price for J&J has been suppressed a bit in recent years due to bad publicity and lawsuits that really hurt their profits. But long term, I do think that this is both a stock and a dividend that are very dependable and should reward investors over that time. Okay, now moving on to stock number 6, we've got my absolute favorite long-term stock, just kind of in general, who also happens to pay a small but growing dividend, and that is Microsoft, ticker symbol MSFT, which is actually my number 1 largest stock as well in my entire portfolio. And I won't waste your guys' time. Most of you already know why Microsoft is such an obvious stock to own long-term, as they dominate in areas of business, productivity software, cloud computing, gaming, artificial intelligence. The list just goes on and on. But as such, the stock price very rarely ever dips, but when it does, you really shouldn't even think about it. This is like an obvious automatic buy for the majority of us. Financials are always insanely strong with unbelievable growth for their massive size. We're talking over $150 billion in sales this year, and yet they're still growing at double-digit rates. That's insane. As a result, Microsoft is able to not only build up a gigantic balance sheet as well as reinvest in growth through innovation and acquisitions, but they're also able to pay out a decent dividend that is admittedly small at just above 1%, but the payout ratio is very low at just 33%, meaning they have plenty of room to grow it more in the future. They have a double-digit growth rate on it, and they've already grown that dividend consistently for the past 17 years in a row. Again, this isn't the most exciting dividend stock from a current yield perspective, but it's a healthy dividend growth stock that you can also build your entire portfolio around, as I've done with mine, and that makes it a great pick overall. Okay, that yield was very small for Microsoft, so I'll give you guys another high yielder for stock number 5, and that's going to be my favorite biotech stock in ABBV, ticker symbol ABBV. It's a stock that has been all over the place in the past 5 years, but I really think every dip has been a buying opportunity, as most of them were overreactions. Their best-selling drug Humira is set to lose patent protection in the US in 2023, which is a very big deal considering that it was recently generating more than half of all their total sales, which has been a major concern for investors. But AbbVie has done a great job of not only developing other products that lessen their dependency on it, including a gigantic pipeline that you can see right here, but they also made a huge acquisition of Allergan that has already lowered their revenue dependence to just 40% in 2019. Meanwhile, sales are expected to surge by close to 40% this year and almost another 20% the year after as well, given the major changes. Still, the stock is low enough to where the dividend yields almost 5% with a very reasonable payout ratio of less than 50% and a huge growth rate of over 18%. Add it all up, and AbbVie is by far my favorite and best performing biotech stock in my portfolio at the moment, and as such I had to include it in today's video. But if AbbVie doesn't quite tickle your fancy, there are plenty of other biotech dividend stocks to choose from, and one that I don't own yet myself, but I've been highly considering it lately, is the pharmaceutical giant Bristol Myers Squibb, ticker symbol BMY, a biotech company that is famous for their market leadership in areas of cardiovascular, oncology, and immunology treatments, most of which have been fueled greatly by acquisitions like the gigantic one they made last year of Celgene that was worth almost $75 billion and left them with ownership of at least 9 blockbuster products with a very large and high growth pipeline to go along with it. The result has largely been strong sales growth over the years, but like much of the pharmaceutical industry that has been beaten down by Wall Street over fears of drug price reform, BMY stock is actually negative over the past 5 years. However, that poor performance has left new investors with not only a cheap valuation, but also a very attractive dividend that yields over 3%, has a really low payout ratio, a decent growth rate of almost double digits, and 14 years of solid growth. Like AbbVie, Bristol Myers looks very promising as a long-term dividend payer. Understandably though, many feel that biotechs are just too risky for their portfolios, and as such, I'll give you guys a much safer stock now that pays one of the most reliable dividends out there, one of the most reliable in the world, and that's going to be PepsiCo, ticker symbol PEP, coming in at number 3. This is a giant food and beverage company with over $23 billion brands, meaning they generate over $1 billion each, that's a lot, being sold in over 200 countries around the world, generating not just tens of billions of dollars in sales, but double-digit billions of dollars in profit as well. And thanks to their very popular and well-diversified portfolio of brands like Pepsi, Gatorade, Doritos, Cheetos, Lay's, Quaker, Tropicana, Aquafina, Naked Juice, even a partnership with Starbucks, and many more, the stock rarely ever dips, and when it does, you probably should be buying, just like I have in the past. Admittedly, the stock is high and therefore the dividend yield is less than 3%, but I think anytime that yield climbs up above 3%, the stock is kind of a steal considering that gigantic growth history of almost 50 years in a row that is unmatched by most of the market. Again, it's the type of stock that performs best when you pick it up during a downturn, during a dip on the stock, so I'll probably be waiting for some dips myself as I already do own this one, but I'm pretty sure that we'll see some dips this year, and that's when I'll be taking advantage of it the most myself. Okay, now if PepsiCo is still too risky for you, if even that one is too risky for you, then perhaps you might be interested in an ETF, since those kind of group together a large amount of different stocks to provide you with some diversification and added safety. And when it comes to dividend ETFs, my personal favorite is the Vanguard High Dividend Yield ETF, ticker symbol VYM, and there's several reasons why. First off, for an ETF, the yield is pretty good at over 3%, and that's because the stock price took a big tumble in 2020, which left it about flat since the end of 2017. So basically 3 years now that the price hasn't really gone up by much, so buying it here, or especially if you can catch it on one of their dips, then you get a pretty sweet dividend in return. On top of that, VYM is well diversified across many different sectors, although admittedly I wish it had a lot less exposure to financials given the current state of the economy, but that's also likely the reason why the price has stayed so relatively low. But they also hold every single stock mentioned in today's video except for Microsoft, and a sum of over 400 different stocks in total. Add it all up and VYM is a pretty good dividend ETF with a high yield considering that they don't own any rates or much oil and gas either, which I consider both to be a lot riskier. And finally, the last dividend stock that I'll go with for today's video will be what I consider to be a pretty good compromise stock in Verizon, ticker symbol VZ. And the reason I call this a good kind of compromise stock is for a few different reasons. The stock has been mostly suppressed over the past 5 years around that $50 range, leaving a reasonable valuation that is over 30% cheaper than the sector and a very nice dividend yield of over 4%. The trade-offs are the low financial growth over the years, with this past year actually seeing a revenue decline of about 3%, before returning to growth the year after. But in fairness to Verizon, there are some brighter spots in their business, like their growing internet and wireless businesses where they dominate. Last quarter saw an additional 140,000 Fios subscriber ads, up from just 30,000 the year prior, and their wireless market share is higher than both AT&T and T-Mobile, which will likely remain in the lead thanks to their ramp up of 5G ultra wideband and their consistently top ranking in customer satisfaction, reliability, and speed. Add it all up, and Verizon looks like a pretty good alternative or even complementary addition to my larger AT&T position. But there you have it, guys. Those are my top 10 favorite dividend stocks as of right now. Now, if any of my opinions change, I'll be sure to update you guys in the future, so make sure you subscribe for that and leave your thoughts and comments down below. Let me know if you like any of these stocks or if you would change them for any other ones. Are there any stocks that I left off the list that you would like me to include maybe in a future video? Let me know down below, and I'd love to read those and respond and make some more videos on some of those as well. Thanks again for watching. Hit that thumbs up if you did enjoy the video. I'll catch you guys in the next one. Take care. Bye-bye.